Thank you for coming today. I'm Rich Wilson. I'm one of the co-chairs of the local ULI District Council's Young Leaders Group, and I want to thank you for taking time to come to this event today. For those of you who aren't members or are not as familiar with ULI, ULI is a global preeminent real estate and land use organization whose mission is to provide leadership in the responsible use of land and create sustainable and thriving communities. The local district council is about 800 members, very active, has regular monthly events such as this, as well as other venues and forums and networking events. And we encourage anyone who isn't a member to become a member, and anyone who isn't already involved to become involved. Jerry Lipp and Aaron Nardini are here, who are ULI staff, and would be happy to talk to you about the different levels of membership and ways to get involved. So feel free to see them after this event. A couple other things I wanted to note, because we're here at Villanova, ULI, the local district council, has put together a scholarship. And we're taking applications for the scholarship. So if you know students, or if you have family members or relatives who are students, we are offering a $1,000 scholarship for undergrads and $2,500 scholarship for graduate students who are studying real estate or land use professions. And they don't have to be members of ULI, so please spread the word. Also associated with that, upcoming in April, we are holding a basketball tournament looking for both sponsors as well as participants in order to raise money, additional money for this scholarship. I'd like to thank our sponsors, as always. The Young Leader Title annual sponsors are TD Bank and KPMG. I'd also like to thank our supporting annual sponsors, Commonwealth Land Title Insurance Company, as well as the Daniel M. DiLella Center for Real Estate here at the School of Villanova School of Business. And with that, I'm going to hand it to Jessica, who is the director of the Daniel M. DiLella Center for Real Estate, and she can talk a little bit about Villanova's program.
Thank you. I'm Jessica Taylor. I'm the administrative director with the DiLella Center here at Villanova. Our program director, Sean Pounton, is right here in the audience if you have questions for him. And I just want to take a moment to give us a little bit of a plug. We'll be celebrating our 5th anniversary of the Real Estate Center here at Villanova in November. And we've come a long way in a very short time. We now, as of this year, offer an undergraduate co-major in commercial real estate, as well as a minor. And we also offer a real estate concentration within our MBA program. To help us continue to expand the programs that we offer and continue to get folks such as yourselves involved, we've just launched this past September a membership program. And it's an excellent way for you to get involved with our students, who will ultimately be the next generation of real estate leaders. So if you have any questions about the program, would like to get involved, have an interest in guest lecturing, mentoring, participating in any way that you can add value, come and talk to me, talk to Sean, talk to Dan. We've got these little flyers out on the tables. I have some as well. So just raise your hand, ask some questions. So thank you. And then over to Jay.
Great. Thank you, Jessica. Thank you, Rich. Welcome, everybody. Thank you for coming. This is our Real Estate Capital Markets panel. You know, we found the way out of the woods, but we're on the right path. What I want to do is just go through some ground rules first. If you have cell phones, just turn them on mute or buzzer so it doesn't interrupt us as we're going through this. Hold the questions to the end. We're going to go ahead and we're going to go through some presentations and some Q&A amongst the group. Then we'll open it up to questions, probably the last 15 to 20 minutes. And then I want to thank the panelists for attending today, for their knowledge and their insight. I'll introduce each of them. I'll give a little quick discussion of where we've been, where we at now, and then I'll kick it off to each of the panelists to give a presentation for their various core areas of concentration. First on our panel, we have Dan M. DiLella, who's the President and Chief Executive Officer of BPG Limited. He's got a 37-year real estate career. He's the CEO of BPG Properties, and they obviously are actively involved in the private equity world in relationship to investment in a variety of different entities, especially real estate. He holds a BS in Finance from Villanova, and also an MBA from St. Joe's. Second, we have Robert Fahey. Robert is an Executive Vice President with the Capital Markets Institutional Group of CB Richard Ellis. He's a real estate broker. He's been with them for a number of years now. Prior to that, he was with Cushman & Wakefield for 18 years in a similar capacity. Lastly, we have Steve Perricone. Steve's with Wells Fargo's Commercial Banking Group. He's a managing director in that group. He's got a good career base prior with Lend Lease, also was an appraiser with Joseph Pasquarella, which is now Integra Realty Resources. So we have a fantastic group of panelists to talk about the entire capital stack, if you will, of real estate, from the private equity, the marriage individual, the broker, from buyers and sellers, and then the debt placer. So obviously, everybody here has been involved in real estate over the past several years. Has been pretty tumultuous. It's been sobering to many. Obviously, the last few years have been a period of deleveraging. To look back, this economic downturn, which was started by housing, the housing bubble, if you will, and then over also too much leverage, created a lot of problems into 2008 with the collapse of Bear Stearns, with the collapse of Lehman Brothers, the bankruptcy of Lehman Brothers, and then also the Treasury Chief Paulson going to Congress with 3 pages trying to avert a global capital meltdown. And consequently, the Fed bailing out a lot of different institutions and trying to infuse capital back into the marketplace over the past few years. So 2009 was a year of credit problems at a lot of credit and lending institutions. It was also confidence was very troublesome. In 2010, sort of seems like things bottomed out a little bit. Mergers and acquisition activity was up. Lenders became more active in the market as they sorted through what they had to work through, and as far as problem loans and problem borrowers. And then in 2011, we had sort of an era. We had an era of less, but we had more transaction volume on top of 2010. You have more lenders in the market. You have a low interest rate environment. So that brings us to date, sort of where we're at now. And what I'll do is I'll let Dan come up and give a quick presentation of his world and sort of where he sees things. Dan.
Well, I'm just going to stay right here if that's okay with you.
That's good.
It makes it a little bit easier. The first thing that comes to mind is that, and I put this up here on the first chart, everything in our business is trends. And the trend that we have not seen in the last 3 years is job growth. And without job growth in real estate, we don't fill buildings, and we don't fill buildings. The money stops, the banks get mad, everything's a problem. And the job growth is still not there today. So obviously job growth goes to leasing. Consumer spending has been spotty at best, and if you read the different the reports this year, somebody said Christmas was great, somebody said Christmas was terrible, but it probably was flat. The biggest issue, in my opinion, is political uncertainty. As you can see here, the cost of doing business has been crazy for all of us. We can't even figure out, as most people, which I think keeps people holding back their decisions, on what it's actually going to cost them doing business. Recently, as of like 3 or 4 months ago, we became a registered investment advisor. Now, not that we have anything to do with the securities business, but we had to because one of our big LP partners insisted that we become part of this because they got trapped into the whole Dodd-Frank bill. Now, to give you a little bit of information on the Dodd-Frank bill, there's 2,300 pages, 400 new regulations, most of which have not been written yet. So if anybody wants to cure for insomnia or anybody wants to try to find out what's going on, try to read it, and it's not even done, and it's going to be a mess, and it's supposed to create transparency. Now, this was in Business Week last week, and this is the chart that they gave you. They said if you don't want to read the 2,300 pages, look at this chart, and I bet you everyone in this room is on this chart somewhere. So you are going to have an impact on this if this thing continues to go forward. So unfortunately, that's what we're going to be living with. The interesting issue, risks and uncertainties have not declined much from a year ago, and that's pretty much where we are today. Now, there was I don't know if anybody in here is from Citibank, but their economist gave a speech at the beginning of the week, and they pretty much say that between now and 2013 and 14, if you believe economists, by the way, that the peak is going to be a malaise, whatever exactly that means. A couple of weeks ago, several of you were in the room with the Integra guys. They were a little bit more optimistic, and I would rather be optimistic than pessimistic. They think things are going to bump a little bit faster. So be it. But things are pretty much where they were a year ago. If you recall, and I think Jay talked about this a bit, beginning of 11, we saw some increased leasing, and then the second half of the year, starting in about June, between the banks and the leasing, everything came to a grinding halt. If you recall, we had all the debt issues and everything else, and then again, our leadership failed, and we're back to where we are. Things have seemed to pick up a little bit, but and we signed quite a bit of leases in 2011, and we had our company meeting, our annual meeting, Tuesday and Wednesday this week. So I happen to have this number on top of my head because I just saw it. We signed 414 leases in 2011, totaling 4.2 million square feet. Now, probably the majority of those were pretty much renewals, but there was probably a good 25% were new leases or people juggling and moving around. There weren't very many expansions, as probably most of you know. People are taking less space. The opportunities, longer holds, and everybody's looking for cash flow. Probably, I think some of these guys are going to talk about the investments themselves, but if you have a property today that has cash flow, long-term tenants, you're going to get a premium. If you have a property today that's mediocre in a tertiary market or even a secondary market, you're not going to get a premium, even if you're lucky to sell it at all, at anywhere near where you think the values are going to be. Many fund sponsors will disappear. New strategies will emerge. I think Robert has a chart here because I was looking at his charts earlier. He's going to talk about some of the fund managers, but by far, the number of managers in the business today has dropped dramatically, and the number of people who are able to actually close on their funds has dropped dramatically. And I won't go into that because I think he's going to talk about it, so I don't want to talk about one of his charts. Investors are returning to fundamentals, and what that basically means is the LPs that we're seeing are going much more vertical into asking questions. You're getting a proctology exam when you sit down with these characters and talk to them. I mean, they're going through everything. How your fee structure is. And one of the ones that I thought was really interesting that we got several, and this is coming from their consultants, is they'll say to you, if you remember how you make these fund investments, that the GP has to put a certain amount of cash alongside the LPs. In the past, and we have never done this, but in the past, many of the GPs would go out and sell their position to someone, or sell their promote position to someone, so really have no skin in the game. So now they're giving you a form to sign as a representation that you are writing the check, you're not borrowing the money, and you own the promote. So everything is going vertical in that business right now. Investment selection, everybody wants to know what you're going to buy, how you're going to buy it, and the question that I love the best is when you're sitting down talking about a new fund, where are you going to invest in and what's it going to look like? I have absolutely no clue what it's going to look like and where we're going to invest it. We're going to look for opportunities, but you can't say that. You basically, what our goals are, and they've always been, we pretty much accomplished it in the 11 funds. We're on our 11th fund. A third multifamily, a third office, and a third what we call other, and that's industrial and retail. And a few years back ago, we threw a couple of hotels in there, and that was an interesting experience. And here, and one of our bankers will probably talk about it. The banks they're going to be recapitalizing quite a few of the investments. Either they're going to have to stand still. Of course, with the interest rates where they are, you can stand still for quite a while. But the day that they get a tenant, somebody's going to have to write a check to put that tenant in there. And we hope that we become that mezzanine partner and be able to write that check and get involved in a new investment. Investors will revisit LPs and GP relationship, no question. They want more control. They want lower fees. Smaller funds. The next chart that I have here, I'll show you the different sizes of the funds that we've done over the years. And everyone starting in about the early 90s, every next fund was bigger than the last. If you recall the exuberance that went on between 05 and 08, the fund managers went into the billions, $2, $3, $4 billion. To get that kind of money out, everyone was taking risks that they shouldn't have taken. Everyone expanded their horizons where they thought they shouldn't be. If you were in value add, you were doing some opportunistic. If you were an opportunistic, you were doing absolutely crazy transactions. And they just went down that path, and the money got out. That caught up with everybody in 08 and 09, and I think what you're seeing now is smaller funds. Our fund number 9, which is really 11 because we had 2 of them that actually had names. Fund 8 was $850 million. Fund 9 is we're shooting for $250 million. We had our first closing in September. for about half that amount. We can go up to $400 million. And the strategy that we've been telling our LPs is that we want to get the money invested in this economic period so you understand what we're investing in. Many times when you get these very large funds, they're going to be investing over 2, 3, 4 years. You're going to have a whole different economic position in 2 years from now, and they may not like that. Plus, more importantly, if you have $1 billion for someone like us to get that's going to take 4 years. You're talking about a 12 to 15-year fund by the time you actually get paid. If you do something that's maybe 200, 250 million, you can actually get the money out in 18 months to 2 years. It's basically going to be a 5 to 7 year investment horizon. So you actually can see yourself getting paid on some of these investments and work in this economic structure. So shorter investment periods, where's the money coming from? And now we're also seeing quite a bit the different funds want direct access. They think they want direct access. They'll sit there and they'll tell you that, well, we want to be able to pick and choose. We want co-investment. And we're seeing that from across the board from these various consultants who represent many of the big pension funds. They want co-investment. They want to make some decisions with you. Or they want direct one-off deals. But then they don't want to pay you for the one-off deal. They want one-off deals, and then they want to put them together as a group and make sure that they get all their money back, and that's certainly not working. So I think the fund structure is going through some changes. I had dinner the other night with the people from Townsend out of Cleveland, and we talked about this exact thing, that the fund structure is under stress. We're not sure where it's all going. Me talking to them about our Fund 9 and who they have that like to join that, all they talked about is what one-off transactions do I have that we can give them that they can bring to an individual investor. So there's going to be opportunities out there. Again, we're going through some changes in the marketplace. And like everything else in real estate, like all of you people sitting here, we've done all this before. These are the cards we have. Play the cards we have. Move forward. We'll figure it out if only Washington can actually maybe stop passing legislation and give us a chance. And this is the last chart that I have, and this is basically showing the various funds that we've done over the years. And my point being, as you can see how everything has grown all the way up through 07. In 2010, we did a small multifamily fund with specific assets in them. And then, of course, there's our fund number 9, which I put down at the minimum of $250 million. And we did have our first closing on that in September of 11. Thank you.
Thank you, Dan. Robert.
Good morning. Nice crowd for a rainy Friday. Thanks for coming out. I thought, as a start, that I'd provide a quick overview of the property markets, really from a national perspective, and sprinkle in some local stuff. And really from a leasing and a sales and to some extent financing and the equity perspective, and then give you a sense of where we see 2012, what we see coming. And share with you one thought that when I was collecting some data for today, the 2011 data, many of these charts you're going to see go back to 03, 04, 05. And it's pretty clear that where we are has a lot of similarity to where we were in 04 and 05. Statistically, amount of capital in the market, vacancy rates, cap rates are a whole different story because of where yields are in general. But to me, it feels a lot like 04, 03, and that was not such a bad time. If you forget about the bubble we were in 06, 07, take that out of your 10-year average, it wasn't a bad time to be in the business. Yep, thank you. Here's a snapshot. These are national statistics collected by CBRE, and the first 3 columns are vacancy rates over the past 12 months by quarter. And I guess the summary statement here is that for all but retail, we're 2 or 3 years off the bottom. So we're out of the woods from an occupancy standpoint. It's not a hockey stick improvement, but it's a gradual trend line that's going left to right. So that's not a bad place to be, and again, it's very similar to where we were this time in 04. Hotels and multifamily are very stable. Retail, office, and industrial still have some time to go. And if you're in the business of leasing office, industrial, really anything involved with leasing. This is a pretty good slide. CBRE is probably the best proxy you can get for the health of the commercial market across the country. We're huge, which doesn't mean we're the best. We just happen to be the biggest. I think we're the best, but it's not a commercial. And we're public, so the information's good, it's transparent, the data's all good, and it's very diverse. We're in 250 markets, and that's what all these statistics come from. So look at the trends. Our average lease volume in 2011 was over 31,000 leases per month, and the trend, again, it starts out on the left and goes to the right. Number of sales averaged about 4,500 properties, and that's big stuff on Park Avenue and little retail deals in South Jersey. So it's a good composite for the country. So again, it's a good trend. This slide is a national perspective of investment properties that traded in 11 above $5 million. Company called Real Capital Analytics aggregates all this data, and that's where all this information comes from. And you'll see the bubble of 07 was about $500 billion worth of real estate traded, and then we all fell off the cliff. And you see where the green line at the top, as compared to the yellow line, except for office and retail, it's pretty much the same. The volumes we're doing now are very similar to what we were doing in 04 and 05. And that's, they were good numbers, and that's where we are now. Philadelphia, in comparison, last year we did $2.5 billion worth of sales above $5 million. Big volume, it's 100% higher than it was the previous year, market-wide. And this is multifamily, industrial, leased property, investment property throughout the region. I'm not going to spend a lot of time on this slide because my colleague to the right is going to handle the loan side, but CB has a fairly large loan placement platform. Again, it's diversified across the country, so the trends are good. And what this basically says that if you look at 11, which is all the way to the right, we did about 900 loan placements, and if you go back to 04, we did 945. So again, I'm trying to get the point across that where we are, forget about that little bubble in the middle between here and 04, but where we are is 2004 again. And 2004 is a good spot to be in on a long-term average basis. Again, back to the lending platform, one of the areas we're going to talk about later is where the stress is in the market, where it came from, and how it's being dealt with. The bottom table here is, again, a composite of delinquency rates for commercial loans in various portfolio types, insurance companies, CMBS, banks, and the agencies, the Freddies and the Fannies of the world. And a good long-term average for any of those lenders is something less than 1%. And if you look at the 07 number, everybody was under 1. So 07 was healthy, things are great. We hit 08, we all know what happened in 08 and 09. And really the interesting thing here is when we start talking about where the stress is, if you look at CMBS and you look at the banking sector, you see who was holding all the risk at the end of the cycle. It's those two. The life companies, conservative, well underwritten real estate, you know, their delinquencies went up by a lot, but as a percentage, they're still well below 1%. Fannie and Freddie, still with support from all of us every week through our tax system, they're still healthy. But the CMBS people that were buying all the risk and stuffing it into the tails, as they used to say, that's where it all sits. This is the table that Dan was referring to earlier, and there's a lot here, and I'm going to summarize it to make 2 or 3 key points. One of, and the data comes from a company called Prickwin, which is an aggregator of private equity data, placements across a broad spectrum of investment types, real estate being one of them. And a good barometer for current values, future values, liquidity in the market, market activity, health of the whole hemisphere is how much equity is in the market. And what this basically says, if you start at the top column and go to the left, across the globe there's about 500 funds trying to raise about $170 billion worth of equity currently, last year, this year. And of those 500 funds, about half of them are predominantly focused on the U.S., 270, trying to raise about $100 billion worth of capital. As Dan said, they won't all be successful, but that's the goal. And if you look at a 4-year or an average placement of $25 billion of equity a year, there's about 4 years of capital being raised today, capacity, which is significant. But what's more significant is the column all the way to the right on the top, and that's what we refer to as the dry powder in the market. This is money that's been raised and committed and is sitting on the sidelines. And today, in the U.S., there's about $33 billion worth of equity, and that's for everything from apartments to broken retail and everything in between. So it's diversified. And levered up, it's 60, 70, $80 billion worth of buying power, which is a lot of money. And that's just the institutional side. That's not private. That's not some other sources of capital. So there's a 2 or 3 year supply of capital sitting on the sidelines, money that's raised, ready to be invested, which is going to support property values, assuming the economy stays healthy. And then if you go to the bottom, again, underscoring this point of 04 and 2011, 2012, fundraising in 04 was about $30 billion, capital that was actually raised. And in 11, it was $33 billion. So again, we're kind of back to where we started. And then a few summary points. In my business, selling leased institutional quality real estate, it's really a dumbbell. You have exceptional quality trophy stuff that's as liquid as a 10-year Treasury bill today. See the front page of the Business Journal today, and there's a great example of that. And then you have junk, broken real estate, bad locations, tenants that have defaulted, whatever the issue is, but the trash. That's very liquid, deep market, lots of volume. And then you get that broad middle, can't move it, to Dan's point. The ownership has no interest in selling at current pricing. They have the ability to hold it. Nobody wants to take the risk. Nobody knows how to price the risk. And it's very, very difficult to raise the debt to go along with the equity to buy that risk. So it's a very illiquid market for all those reasons. And a lot of it just gets back to jobs. How long is it going to take you to fill an empty office building today? You know, you would have bought that risk 2 years ago, 5 years ago, and said 2 years. I'll fill it up in 2 years. If you bought it today, you'd probably say 5 years, 10 years. Who knows? Nobody knows.
2 weeks.
2 weeks. 2 weeks to say no. And where are we headed? I think the reality is if you go back to what the Fed did this week, rates aren't moving for 3 years, 4 years, 5 years. We're in an environment where real estate's going to be priced at, real rates of return, riskless real estate, if there's such a thing, 5 and 6%. And that's going to be 2 and 3 times treasuries, which is a great premium relative to the way the markets always were priced. Risky real estate is going to get priced as though it's really risky, and pricing is going to be horrible for a long period of time until we get job growth.
Great. Thank you, Robert. Steve, going to talk a little bit about the debt marketplace. So let me go ahead.
Good morning, everyone. I'm in an interesting position. Our group is part of Wells Fargo, but we're a brokerage arm. So we deal with many different lenders, insurance companies, CMBS lenders, the agencies, and commercial banks. So we kind of run the gamut of various parameters that lenders have today. And where I wanted to start was just kind of where we are today and where loans are being held. And first slide will show that. But basically where we are in the cycle is we're on the roller coaster, and we're on the upward. We're slowly going upwards. We've passed the downturn, the real dark days of 2008 to 2010. And 2011 was a very good year. At least it started out very good. And then the summer stall occurred, thanks to our friends in Washington with the debt ceiling debate, Eurozone issues, and just a general risk aversion. And as far as where mortgages are held today, I'll kind of walk through this until we catch up a little bit. The bulk of $3.1 trillion in existing loans is held on commercial banks' balance sheets. And those could be construction loans, value-add loans, recourse loans, as well as stabilized non-recourse loans. And that's over 42% of the existing loans that are out in the marketplace. So very, very large segment, and a segment that has made a strong comeback over the past couple years. They're aggressively pursuing, in fact, I had conversations this morning with a few bankers, they're aggressively pursuing quality real estate loans, mostly stabilized, but they're also considering some construction loans for multifamily. The second largest segment is the CMBS segment, and that was started out basically in the 90s as kind of a niche product and then grew into something that now has 20% of the existing loans. And that's one area where there has to be significant growth going forward to satisfy refinance needs, as well as to help move some of those B products and B locations and kind of a little bit off the run, non-core properties to get those financed. And 2011 started off pretty well, then the second half of the year was very slow, but 2012 we're seeing positive signs. It's only 3-4 weeks old, but there's a lot of traction in the CMBS market where investor demand is coming back and spreads are starting to narrow. Another segment that is actually very strong these days is the insurance company segment. They make up about 10% of the existing loan market, and they are actually originating loans, excuse me, at levels consistent with peak volumes in 2006 and 2007. They're roughly 10% of the market. And really what's amazing about their production over the past year or two is that they're doing it in such a conservative manner. They're able to almost do double their allocations by doing 65% loan to values on A markets, premier property types with premier sponsors. So it's a very, from a relative value standpoint, it's a very strong business for them. The GSEs, as Robert alluded to, are being supported by us. But frankly, the multifamily segment of Fannie and Freddie, which that's all they do is multifamily, is 8% of the overall loan market. And their default ratios, I think was in one of your slides, is under 1%. So it's performing extremely well, and it's a highly profitable portion of both Fannie and Freddie. So although overall Fannie and Freddie need to be fixed, and who knows what the future holds, that portion of Fannie and Freddie is highly profitable. And the balance of existing loans are in thrifts, finance companies, kind of owner-occupied, specialty use product types that really aren't within what we do generally, the people in this room generally do. Talk.
Never mind.
Hand signals.
You have to go again.
There you go. All right. The insurance company marketplace, we alluded to, they have 10% of the balance of existing loans. And in 2006 and in 2007, the height of the market, they originated $44 billion and $43 billion. In 2011, they originated $43 billion. So you're matching those historical or peak levels, but yet you're doing it at a very conservative level. We expect growth in this market. They're still very active. They're coming out very aggressive in the first quarter. But we think the growth that's going to satisfy some of the demand, not only for refis, but also for kind of B markets and B property types, is not going to be generated from the insurance companies. We see continued strength, but moderate growth in those markets. On the CMBS issuance side, 2005 through 2007 were the party years, where 169 to 230 billion were originated. Most of those loans are 10-year loans, and they're going to have a large component of interest only. I think 70% of those loans have either partial or full-term IO interest-only segments to it. So that's an issue that I think will come up later in our discussions. But those were the party years, and then 2008 through 2010 was definitely the hangover, where there was virtually no CMBS issuance. In 2011, actually the latter parts of 2010, CMBS started to come back. It was primarily for low-leveraged REIT-type borrowers. But 2011 started off extremely strong. There was a lot of traction, a lot of origination, and then come June,
There we go.
All right, there we go.
Thank you, Jess.
So you see in 2005 to 2007, those were the peak years, and then virtually non-existent from 2008 through 2010. And 2011, if you broke that out by quarter, you'll see most of that production was in the first half of the year, and then we had the summer stall for a variety of reasons. There was a risk-off trade, and CMBS was not a preferred vehicle. What we're seeing in 2012 is very good traction, reduced spreads, a lot of investor demand, and rates in the low to mid fives. And that estimate of 25 billion was compiled probably in the fourth quarter when it was very negative sentiment. I would say today, my view and most others will be that it will be at least 35, 40 billion, maybe as much as 50 billion. So it could be double that. But as you'll see in another slide, that's not nearly enough to kind of satisfy, to generate economic growth, to handle the refis, as well as handle new investment activity outside of kind of core property types. Talked a little bit about maturities, and from 2012 through 2014, you'll see that the bulk of the maturities are on banks' balance sheets. Insurance companies have 27, 28 billion in that range over the next few years. But the bulk of the maturities, or I shouldn't say the bulk, but higher than the insurance companies, will be on the CMBS side. You have 44 billion as a low point and 65, which is projected for 2012. And if you just look at the type of deals that were done on the CMBS side, a little bit higher leverage, and then you look at projected production or origination volumes for this year, it doesn't seem to match up. So I think we need, for a healthy commercial finance market, we need to see that ramp up a little bit. Banks are very active. They should be able to handle their rollovers and new business. And insurance company rollovers are very manageable and are far below what their projected volumes will be. Alluded to this earlier, CMBS maturities. If you look at the next 3 years, they're fairly substantial, but then the bubble hits in 2015 through 2017. You have 96 billion as being the low point during this period, and up to 135 billion. And a large percentage, that time period, they're 10-year loans, so they were originated in 2005 to 2007, where pricing was to perfection and underwriting was to perfection also. And then you throw in a large percentage of them were interest only through the entire term or partial term. That's going to create an issue. So we need improved economics on a macro basis. We need a continued growth in the CMBS originations to kind of handle that issue out in that time period. We get asked all the time to kind of give an overview of where lenders are today, the different lender types. And I could say in my career, there's never been a time where a deal, if you're looking at a deal, where it fits so many different lender types. Before it used to be, that's a life company deal, that's a CMBS deal, or that's a bank balance sheet deal. Today, it seems there's such a crossover in deals. And across the top is the lender type, and down the side are the underwriting parameters. And as you can see, The insurance companies are the most conservative. Their stated maximum loan to values are 65%. They're looking at 10-year money. They prefer 25-year amortizations, but will go for the right deal, right sponsor, right market, 30-year amortization schedule. And again, they're only looking for A-quality real estate in primary markets like Philly, Boston, Chicago, or gateway markets like San Francisco, New York, and D.C. Preferred property types, multifamily and grocery-anchored retail. They'll look at big box retail also. But if you have suburban office or hotels, that's a quick pass. Or you have something in a secondary market, that's also that's a quick pass. CMBS, again, getting traction. The trade-off here is you're going to get higher leverage. You're going to get a little more structure. You're going to get 75% leverage. You're going to get a 30-year amortization schedule, and it'll be more of a catch-all. You're going to get A and B property types, primary and secondary markets, and they'll go beyond just grocery-anchored and multifamily. They'll look at hotels, industrial, and well-leased suburban office. So the trade-off there is a little bit more in proceeds, but a little bit higher rate. You know, their rates are low 5s to mid 5s, roughly 5.25, 5.75. Whereas the insurance companies are going to be in the low to mid 4s for 10-year money. The GSEs still dominate multifamily. If it's an A or B property type, A or B market, they're going to have the best. They're going to have the best bid on the table. They're going to be 10-year money with 30-year amortization, and they're going to be up to 80% loan to value. And again, A and B property types, primary and secondary markets. And as far as the banks, I think this is one of the big changes over the past couple of years is the banks are doing more stabilized real estate, and they're doing it on non-recourse basis. Not for all deals, but if it's stable and it's maximum LTV of 65%, they're looking at 7-year deals on a non-recourse basis at 20 to 25-year amortization schedule. And if you swap the rate out, it's going to be somewhere in the mid-4s today. So a very strong option today for borrowers. So that's pretty much the kind of where we were, hopefully where we're going, and then kind of how the underwriting is today.
Great. Thank you, Steve. Now we're just going to ask some general questions up and down the panel. I'll forward them, and then we'll open it to Q&A in the audience. My first question, Dan, is to you. The fundraising environment. Private Equity Magazine says there was about 300 emerging managers that were trying to raise their first, second, or third fund. There were about $100 to $500 million fundraisers, but only about 12% has raised some capital for their funds, which is, and unless a third of those managers have reached their targets. You're out raising a fund right now. How are you finding the environment?
I think your statistics say it all. And just to point out on Robert's statistics, and we looked at the same things, and they're just slightly off. There's about 500 global funds, 250 in the U.S. Only 20% actually closed in 11. And of that 20%, it's skewed because you have the Greystone, the Blackstones of the world, and the Morgan Stanleys who are out raising the $1, $2, $3, $4 billion funds, and everybody else is under 200 million. And of that 20%, or approximately 110 funds closed, I believe, out of that total global number, about 90% were under $100 million. And the rest are, between 100 and above that. We were very lucky. We closed on our first 50% of our fund target, and we have about another 50, 60 million. It's in the pipeline that should close probably in the next 30 to 45 days. But it is very difficult. It takes a long time to get the people through the process. And what we're also seeing, which is interesting, in fund number 8, we had 110 LPs, 45 approximately university endowments of some sort, or university or hospitals. Then we had foundations, about 25 foundations. The rest were public and private pension funds and high net worth family groups. We never really marketed to high net worth individuals. In this cycle, you're seeing the big public pension funds, and there's, again, exceptions, but the big public pension funds who have billions of dollars, and they have a plan, and they just keep going forward with their plan. because they're in it for the very long term. The other side of the equation are the family offices who have substantial money, have sold their businesses, and they don't want a quarter of a point or pay somebody to hold their money. They're looking for yield. And we see them out in the market either trying to buy our product to put their family in some type of business, or they're willing to invest to get any type of current income, and everybody's looking for current income on some basis. So, and that whole group in the middle is on the sidelines. If you recall back in the 05 to 08 or 04 to 08, everybody was doing the Harvard-Yale model, and everybody was allocating money to alternative investments, and there was a whole list of alternative investments that they were doing. They all got burned. They did the hedge funds, and they did, venture capital, and they did real estate, and they didn't have the pocketbook to do that, and they got burned. And now they have issues with, they have their own liability issues they have to deal with, and they have liquidity issues, so they've pulled back. But most of the people we're talking to, I'm doing an out west swing next week, and every one of them is either a consultant and or a large public pension fund.
Excellent. Robert, you mentioned a little bit about back to 2004. What are you seeing as far as obstacles trying to get deals done? You mentioned the haves and the have-nots. Everybody bunched up on the risk curve, if you will, looking for that core property. There's a lot of people chasing that. What about those other deals that are difficult to put together? What kind of assets would those be? Were those broken deals to try to find marriages?
The most difficult thing to do today, broadly speaking, is to sell, and there are 1,000 of these around here, sell a suburban office building that's 78% leased and all the tenants expire in the next 36 months. And that is probably 50% of every office building you drove by to get here today. Outside of Conshohocken and Radnor, pretty much everything else fits into that category. And there's no market for it. There's no market that even begins to support the price that was paid for it in 04, 05, or 06, or 07. So that's the biggest logjam in the market. And absent that, if you forget about property types for a minute and just talk about issues, the issues are occupancy and financing, the same stuff that Dan's talked about. You can't finance buildings that are broken conventionally today, and there's more broken product than there is, and broken's kind of probably a strong word. There's more product that has an issue than there is product that is issue-free. So it's just a very tough environment. So you have the trophies, the stuff that's riskless on a relative basis, and that is as liquid as a treasury bill, and then you have everything else. Unless you're talking about multifamily. Multifamily is a whole different silo. The risk perspectives are different. The pricing's very different. The occupancy issues are pretty much non-existent. So when we're talking about commercial real estate today, you need to differentiate it, the multifamily, or pull that out of the discussion, because that's a whole different discussion.
Excellent. Steve, you mentioned debt capital being very plentiful and lenders being aggressive. Where are you seeing non-recourse deals being done? And is there monies available for acquisition of development loans? We mentioned a lot of these problematic assets that Robert mentioned, but what about failed subdivisions and those types of things? Is there money available for that?
I guess to answer the first part of your question, non-recourse money, all the loans and all the parameters they're still up on the screen they're all non-recourse. So non-recourse money is plentiful, but it has to be a stabilized property. If it's a development deal, there is some interest from banks to do development deals, but it's been strictly, from what we've seen, multifamily and primary markets, and they're not non-recourse loans. They're at a minimum completion guarantees and a lot of skin in the game. So as far as non-recourse, it has to be a stabilized loan. As far as broken land deals for sale, it's not as much the market we work in, but those are under, as you know, everywhere in the country, under tremendous stress. And those are the type of deals that are not necessarily being worked out as much as they're being liquidated.
Okay, great. Dan, back to you. You mentioned about the equity raising side. How are you finding the selling side of, obviously you're harvesting your yields and your funds. How are you finding the selling side? and that redeployment of that capital.
I think you can just go by what Robert said. It's pretty simple. If you have a building that's leased in a good location, you're going to get a premium. And if you have anything that's anywhere else in a secondary market and or not leased, it just doesn't move, and you're not going to want to sell it because you're not going to want to take the hit right now. You want to finish leasing the building. I think the interesting question, if you reverse that a little bit and say to yourself, where are the opportunities going to be for those who have the nerve to want to buy today? If you think the economy is going to turn, if you think a certain city is going to turn, but if you're in D.C., New York, Boston, San Francisco, you've been doing well over the years. Things continue to lease. It's the secondary markets that have been really hurt the most and have the slowest job growth and the slowest government involvement. So it's been that way. But last year we sold, I think it was $240 million worth of product. We haven't acquired anything in 3 years, although we've been sitting on some money. Look, this year so far in Fund 9 and in BPG, what we call the private fund area that we have, we right now have 2 apartments under letter of intent in Virginia, Northern Virginia, that would become part of Fund 9. We have an office building that is in the Scottsdale, Arizona area, right next to a block away from a building we own there that's 97% leased. This is an insurance company foreclosure sale, but we have tenants in hand to put right into that building or we wouldn't be looking at it. And as you probably read in the paper a couple of weeks ago, we have 5 sites in the Delaware Valley for multifamily, ground up. And the first one will break ground on May 1st.
Excellent. Talk a little bit about obviously the stress in the market. I'll open this to, start with Robert, but from your perspective, this selling of distressed debt, obviously the failures of banks and the FDIC packaging up loans. I know you're more of an asset sale shop, but nationally, where are you seeing distressed debt trade at? Who are the buyers? Is it local buyers or?
It's a combination. There's the institutional money that's fairly high out on the risk spectrum is buying some of that, but generally it's private equity. There's some examples that are local that you could point to that would tell you that distressed debt a year ago was selling for 50 cents on the dollar, and over the course of maybe middle of 10 and through 11, it probably got up to 70, 75 cents on the dollar. And I think that market's pulled back a little bit. But the people buying it are generally private individuals seeking yield, comfortable taking risk, foreclosure risk, leasing risk, redevelopment risk, whatever they're buying. And to some extent, and there's some examples of that locally as well, some of the buyers are the borrowers, forming a separate deal on the side, buying the debt back and trying to protect a tax position that they might have or protect or preserve some equity that may or may not be there 5 years from now.
Great. We were talking a lot about risk, obviously. And Steve, where are you seeing this loan maturity risk? I mean, how's this all get taken care of? Barclays, I think, recently had mentioned that 70% of the 2007 vintage 5-year may not underwrite under current standards. And from the smaller commercial bank side, there's been more of the phrase is a rolling loan gathers no loss. What are you seeing in terms of these loan maturities? Is there rescue capital coming in? There's lots of different ways to fix the problem.
I think we're seeing 2 different solutions, and it depends on the lending institution. If it's a commercial bank, not like the early 90s where it was just mass liquidations, we're seeing logic and less stress to just blow things out. They're taking loans, especially commercial loans, kind of one by one, blocking and tackling, figuring out what's a logical solution, and what's going to maximize recovery. Is it going to be in 6 months? Is it going to be in 2 years? Is it going to be in 3 years? There's not the pressure to liquidate it, so they're trying to figure out what is the best solution to maximize recovery. Most times that requires some pain on the borrower side with additional capital investment, maybe cash flow sweeps, but something that gets them to fight another day, to live another day. So that's what we're seeing on the banking side. On the CMBS side, it's an interesting phenomenon this time around because you have the loans are held in a trust. So there's not that forced liquidation that you may have had like a bank who needs their capital back. So what's happening is if the deal fits in the bucket of it makes sense to extend it because there's going to be additional leasing or the market is improving or there's certain positives that lead you to believe that over time you're going to exit it, you're going to see the same type of solution. You're going to see a special servicer, and there's a bunch of different ones, and they have their own set of parameters, some logical, some not so logical. But essentially what they're doing is they're requiring principal pay down in exchange and cash flow sweep. So those are the two important things. They want to see skin in the game and not cash leaving through distributions. So if you give them those two things, then they'll give you an extension. Sometimes they'll reduce the rate and they'll give you flexible prepayment. So we've worked on a number of 2-year extensions where it had a flexible prepay. So all they needed was that one lease to be signed or some more absorption of space on the retail side. And once they do that, they can exit the permanent market, and they can do that without prepayment penalty. So that's two different ways, and it's much different, in my opinion, than the early 90s. They're much better.
Great. This is for Dan and Robert. Sort of where are investor yield targets? I know, Robert, you mentioned that safe rate, that risk rate, knowing the treasuries are really low, sort of 5 to 6. Either Dan or Robert, I'll let Dan go first, or where you're targeting returns either for if you're buying core, your value add, your opportunistic investments.
Great question. I think they're going down. That's for sure. Back in the heyday of investments, if I heard 20% was my target one more time from one more investor that never got 20%, that's all they ever talked about. No matter how they structured the transaction, how the promote was calculated, their target was 20%. And I used to sit there and scratch my head and say, you can't get the 20%. It just doesn't work. We in our fund are basically saying that we're going to get somebody a low teens return, and we actually use the numbers 12 to 14 net leveraged. I think today, as what we just heard the other day, is that they're going to keep the low short-term rate down through 2014, close to zero. Now your yields are going to go down again. Now, does that drop the cap rates again? That drops the yields again? That drops the interest carry again? So people can hold on their properties longer. The values go up a little bit for good property again. So I think the yields are going to come down. I think for the core people, they're looking for 4 or 5%, and that's mostly unleveraged, 4 to 6. I think when you start leveraging it into value add, you're going to probably somewhere in that 8 to 12, 8 to 10 range, and then whatever opportunistic is today, whatever you want to chase and call that. And it used to be how much leverage you can put on, but you're not getting the leverage that you used to get. That'll probably go up into the teens. But I think the yields are coming down, and how long are they going to stay down? But I think the interesting question to ask yourself someday is if the rates ever turn the other way and everybody bought on all the 5 and 6% yields, what are you going to do in 5 or 6 years from now when the rates go up? Who's going to buy this? We're going to have another loss? So good question, and I don't have that answer. Maybe Robert does.
No, I think you got it all. I don't have that answer, but I'll help everybody figure it out in 5 or 6 years. But I agree with everything Dan said. The rates have to come down. Long-term rates are they're obviously the lowest they've ever been, but I think over the next couple of years they're going to come down, and with that comes cap rates.
Question for the entire group: where do you see investment in or preference in terms of, or leasing even, of LEED certified, sustainable buildings? Is there a premium associated with them? Obviously it costs a little bit more to be developed, but maybe it's higher in the rent. Do any of you guys see it from either the lending side, the equity investment, the sales side?
I'll just give you an opinion. I was at one of these conferences about it was about 2 years ago, and they had a major group of, they have like all the LPs in the room, they have the GPs in the room, and there's a lot more of us than them, so the flea on dog ratio was really high in that room, so it was interesting. But they give you a little clicker, and they tell you, they ask the question, everybody clicks, and they said, okay, this is for all of you LPs out there. Would you give up yield to have a higher certification in LEEDs? And 90% said no. So now, with that being said, I mean, today, you know, in my opinion, to take this for what it's worth, I mean, you don't build things that are dumb. You don't put bad insulation in, you don't put bad windows in, you don't put bad systems in. You try to do the best you can to keep the cost of the operation of the building down, and that's what LEEDS is all about. I mean, I don't know where, you know, everybody is green. And I understand that, you know, quite often the big companies, they play the green game because it becomes part of their whole marketing. And if you don't, then they're criticized. But overall, you know, to my opinion, you're green today. Of course you are. Why are we going to do something dumb and cost yourself more money and more aggravation and have to, you know, have bad, you know, if my operation, because I have single pane glass in my building and the electric is twice somebody else, you're not going to get the tenant. So that's green.
I'll answer that from two perspectives. There's a segment of CB's business that is strictly focused on representing big corporate tenants and their moves, whether they're 5,000 feet or 500,000 feet. And if you speak to any of the people that are active in that business about their clientele, and most of it's Fortune 500 type entities, they all want to be in a green building. They all have a mandate from above to satisfy their community image issues and all doing business the right way, et cetera, et cetera. And how much more are you willing to pay in rent to do that? The answer is zero. So it's a mandate, but I think but eventually people end up in these better buildings, which everybody's going to build anyway, to Dan's point. And I'm not sure anybody knows what it costs to really go into a green building. There's a premium, clearly. But I don't think it's quantified. I haven't seen any measurement tools out there where you can go back to your real estate committee and your HR director and anybody else you report to and say, yeah, we just signed a 100,000-foot lease at Continental Boulevard with BPG, and it's a green building, and we paid $1.12 more a foot for the next 10 years to do that. I don't think the math's that good, but it's baked into the rent, it's baked into the deal. On the other side, there are a lot of institutional fund managers that focus on development-oriented projects. And I can think of 2 or 3 that will not go into a building that's not LEED certified. But as Dan said, everything you build today is anyway. So I don't think it's a big issue.
From the lending side, I mean, obviously we're looking at the numbers, and to the extent it reduces operating expenses and it translates into value, that's a positive. But if you're showing a lender, whether it's an insurance company or another type of lender, an office building, they're not asking you, is that a green building? They're asking you, why are you showing me an office building? So it doesn't have an impact right now.
Great. We're going to go ahead and open it up a little bit right now for Q&A in the audience. Is there any questions? Yes.
As the life companies see their rates go closer to 4% or maybe go below, do you expect that they'll pull back and not be as aggressive in 2012?
The early returns in the MBA, as you know, is in a couple weeks, so we'll hear a little bit more. What we've seen is there's two segments of the insurance company market. They're the ones that just say, you know, we can lend at 3 3/4 or 4% because what we're promising on the other side is 2.5%. So it's strictly a margin game. So we see that continuing, but it's not throughout the entire insurance company market. What I've been hearing the past couple weeks as we talk to insurance companies about deals is, you know, we want a little more yield, so we're willing to take a little more risk. You know, today, what does that mean? Like, it means something different to me. That means 75%, maybe a year of interest only. To them, it means instead of 65%, we're going to go to 67% loan to value or 68% loan to value. So they're looking for that value add, but I still think they're going to be more conservative, at least that segment that is that way currently.
Other questions? The group? Yes.
It's really a question for Dan. Dan, last year was a record year for these private REITs raising capital for real estate equity and debt strategies. Do you have a perspective on that industry and its ability to raise capital that'll help fill these various funding gaps over time?
I'm not really a REIT expert, but from what I've been following is that, people are putting money into REITs because they've really performed well in the last couple of years. They give great dividends and people looking for yield. And I think you'll see people continue to put money. However, saying that, I know a couple of people who've tried to go public and did not successfully do that. So for whatever reason, on one hand, the REITs seem to be doing well, but they don't seem to want to be adding anybody to their group. And I don't understand it. I sit there and say, okay, fine, they're going to give a 5 or 6 or 7% yield, and why can't they go public? And they get analyzed, and their risk, and whether the properties are, or whether the quality of the properties. I know that we've been the beneficiary on occasion, both sides, both from a sale and an acquisition side, is that REITs sometimes, and in fact the 2 properties that we're looking at in Northern Virginia, they're in a major public REIT. And some analyst in New York said, you have to get out of that market because it looks better in your annual report, and they need to sell those 2 properties to clean up their balance sheet. And not that there's anything really wrong with them. They need to be repositioned. They haven't spent any money in them in a while. It's a perfect opportunity for us to go in and basically recondition the properties. But they're moving those out because of the stock side. On the other side, if you have something they want, they pay well.
Other questions? Yes, go ahead.
I have a question, and I think this is to everybody. You got Basel III coming in, the Volcker rule coming in. I know you had your regulatory thing, but are you guys worried about some capital flow? Because both Basel, right, it's a risk-weighted asset. So is there some fear of midsummer? I mean, Volcker's supposed to be midsummer, and I don't know how many banks are still involved on the equity side, big banks, but they got to be out. That's what I understand from the Volcker rule, I think. So I wonder if there's some fear of some capital flight during this year due to some of these regulatory things coming online, maybe.
Steve, you're the banker.
I'm out of that one.
Yeah, no, that's a great question, and almost a whole seminar or conference in and of itself. And I think less is more, and I think the more that regulation plays into it, the harder it is going to be to do business, more restrictions, plus the uncertainty. So I definitely see it have an impact on the CMBS market, and the CMBS market is going to be vital to recovery in real estate for B property types, B markets, a little bit higher leverage, handle refi risk. So I think to the extent those come into play, and we've seen some of the regulations proposed, it's going to hurt. It's going to hurt our business.
Other questions? All around the group? Go ahead.
Dan mentioned the proctology exam that is talking to lenders today. The question for Steve is, when you're looking at this kind of matrix that you have up, are there any components that are weighted more heavily than others? In other words, if the sponsor is very good, do you get a break on some of the other factors? Or if the assets in the deal are better, loan to value, can you speak to maybe some of that as far as what lenders are looking at? And then second question for the panel is, with the political uncertainty and European issues and so forth going on today, how do you see that just impacting the market this year?
Just to answer your question on the loan parameters, sponsorship has always been an element and an important element, but today it's paramount. So I think that's where lenders are starting. They're looking at the sponsor, and it has to be a high-quality sponsor, not only in performance, but also performance on loans, but also in experience in the marketplace. So that's critical. To the extent there might be other issues that are not perfect, because a lot of lenders are looking, especially insurance companies, are looking for the perfect deal. I think to the extent that there's other issues, maybe a little bit of lease up, maybe a market that was maybe a little bit overbuilt, to the extent you have good sponsorship, I think that will override it and be able to get the loan done.
Brief comment on the political question, the uncertainty emanating from Europe, I guess. My guess, and I think it's supported by transaction volume from the last half of last year, and the trend I think will continue and probably accelerate. If you look at all the big office buildings that trade in the major cities, downtowns, between now and the end of 2012, the biggest growth, I don't know what the number will be, but the biggest growth in terms of capital coming in and where it came from will be from Israel. The Israeli capital that's always been in the States, there's a handful of people out of New York and other cities that manage some of that money. But I was talking to somebody earlier today about this, I forget who, there you are, Rich. There are 10 people that have been in our office in the last 3 or 4 months that had never been to Philadelphia before. And they all have a business card with Tel Aviv on it, and they speak pretty good English, and they're well advised, and they're trying to get money out for a lot of the same reasons. Some of it's Euro-driven, some of it's Iran, some of it's just political instability. So that single segment, and maybe there will be others, of the equity market will probably increase by 3 or 4 times this year.
Other questions? Anybody else have any other questions? Go ahead.
This may be a question for Dan. How does the commitment restructuring that Morgan Stanley just did on their 7th fund, is that something that's going to be a trend with funds that were set up in 08 where the investment period started to expire, but they still have a lot of money left to invest?
Everyone has done it. If you have a viable fund where you still have equity in the fund, you basically, give an example, if you did a fund in 2000 or 2002, it had a 10-year horizon. Usually it's a 2 or 3 year investment period and 6 or 7 years to work out the property. So it usually gets 10 years with a couple of 1-year extensions. When you get to the end of those, it's not a good time to be selling property that's not properly positioned at this time. Mostly all of the LPs will give you extensions of 2 or 3 years to restructure, but you're also going to take a hit on your fees. You're going to take a hit on maybe some control over your portfolio. As I said the other night, I was out with these consultants who manage, one of the bigger consultants, and they were telling me they were actually one of the one fund wonders. There was a lot of people who split off back in 04 and 05 and started new funds themselves, and they did, that poor timing, they did one in 05 and 06. You couldn't have timed it worse. And they have no other income. They have no other funds that they're selling properties on. They bought all at the wrong time, and those funds are basically collapsing. So one of my questions to him was, where are these GPs, and how do I get myself involved with the LPs at this particular time and get my hands on some of the property where they are willing to take some write-downs, or the banks are willing to work with them? Is there opportunities here? And then he was telling me that they actually were trying to fire a manager who has not been proactive in any of their portfolio. It was a small one. It was a couple $100 million from out in the Chicago market. And he said that with 100% vote from the LPs to throw the manager out, they still can't get it done. The guy's fighting them. They're in lawsuits. They're carrying on. So I think this is going to be I think as a GP and working with your partners, you're getting extensions. The alternative is it takes too long to fight the legal battles to get it done. In the meantime, what happens? The properties continue to deteriorate.
One more question. Go ahead.
As an out-of-town investor, it's hard to keep on track with Philadelphia. It rarely falls on the gateway cities. ULI didn't rank it. What is the Philadelphia story? What do you sell the out-of-town?
It is fabulous, Karen. Like everything, it's changed. 10 years ago or longer, when we first met, probably 15 years ago, it was clearly a second-tier city. From whether you were looking at equity or debt, that's just kind of where you fell. And then through 07, everybody came up the food chain. Wilmington, Delaware was priced the same way Philly was. And Philly was getting priced like it was closer to Manhattan than it really is. Everything kind of came up. And through when the air came out of the balloon in 08 and 09, I think everything kind of settled back to where it probably always should have been, and where it was. So Philadelphia today is, in everybody's mind, a second-tier town. There are only 4 or 5 first-tier towns, and the gap between number 5 and number 6 is wider than it's ever been. So that's where Philly sits.
Great. I'm going to go ahead and wrap up now, unless there's any other questions. But I think the takeaways here are, we have an slowly improving economy. There's jobs. There's an engine in the marketplace. We've got improving market fundamentals. We have more liquidity in the market, and real estate is currently, and again, an important and favorable asset class. And the ending question I'll just have for the panel is there any risk elements or things that you keep your eye on the dashboard as a risk factor looking forward over the next few years, whatever it might be? Interest rate risk or, contagion effect from Europe or anything else that each of our panelists could end on?
Great question. Just to talk a little bit about economists, I was in some meeting about a couple of months ago, and this guy got up from London, and he did a whole big presentation on the world economy. He talked for 45 minutes, and at the end of the conversation, he said, "I give this a 50-50." So so I said, "Well, damn, I can give it a 50-50." But so take all of that. So that's a great question, Jay, but I have no idea where to go with it. But I did take the opportunity to put down my wish list for 2012 because I think it was one of the questions you asked us to prepare or think about. And this is predictions, but it's more my wish list than predictions. I have here job growth and leasing will continue to accelerate moderately. We'll begin to actively acquire properties, slow but steady, a lot of work on them. As Robert pointed out, you're not going to be in the middle of that barbell. You're going to be looking for great opportunities or things that are cash flowing. I think you'll see new construction in the apartment sector. You're not going to see it pretty much anywhere else. More investors will begin to make commitments as a result of actually chasing yield because there is no yield, and I don't know what you're doing with your money, whether you're going to stick it in your mattress or you're going to start paying banks to hold your money because I don't know where it's going. I'm wishing that there's no double dip in the economy, so let's hope that does happen. And my last on this political uncertainty, my last comment is that after the election in November, one of two things, in my opinion, will happen. You have a change in administration, you'll probably get a surge of some sort and maybe feel people have more confidence and maybe we'll stop having legislation. If you have the other switch and we get more of the same, you're probably going to have gridlock. You'll probably have gridlock. Maybe that's not a bad thing. At least then maybe you can work your way out over a longer period of time, but at least you won't get any more legislation. So that's just my opinion.
He's going to stick with it, too. I think there are two big risk factors. One of them is here, and it's coming, and I think it's going to pick up some steam. And I'm not an economist, but I remember facts reasonably well. I think I'm correct in saying that in coming out of past recessions, 50+% of your GDP growth can be attributed to government spending, stimulus kind of stuff. And I think all you have to do is look at Radnor Township or Cherry Hill or Exton or anywhere around the country. State and local governments are broke. The federal government's broke. So that acceleration model, that, putting a little air back in the balloon thing, it's going to happen, but we're not going to have the same level of it that we've always depended on. So I think the acceleration out of this kind of trough and up is going to be slow and a lot longer than any of us would like to see and are experiencing if you've been through a couple of these cycles. So I think that's one that's here, and I think that's a fact. And the other one that's a variable, and I don't know whether it's 50-50 or not, but this Euro thing could whack us across the head harder than anybody thinks. I know the company I work for, and probably lots of companies that are represented out here, it's scaring us to death. If you're a multinational company and some large percentage of your revenue is dependent on things that happen throughout Europe, it's a variable that you can't quantify. And if I don't think it's an if, Greece's debt is trading at yields of 50% today, they're going to default. So what happens when they default? Who's next? Is it Ireland? Is it Iceland? Is it some of the Spanish-speaking countries? I don't think anybody can predict how big of an impact that's going to have on employment. And without employment, we don't fill seats in office buildings, and we don't push rents, and people don't buy cars. So I think
50 or higher?
I'm going to stick with that 50-50, Kieran.
Safe bet.
60-60. From the debt side, we're making positive inroads, and there's still a lot of wood to chop to really get to where we need to be. But a couple things that could set us back, or one thing that could set us back, is regulation. Is one of the questions earlier that was brought up. And to the extent the regulation doesn't impact the way the current lenders are doing business dramatically, or kind of the rebirth of CMBS, I think that's going to be critical in the next 12 to 24 months. Secondly, we talked a lot about office buildings, made a couple jokes about the difficulty in financing those, but job growth is going to be the key. To the extent we get job growth, They're going to fill that office space, and then it's going to open up a whole new segment of finance and to handle refis and stimulate investment activity in that segment. So I would say those are the two areas that I'm watching most closely from the debt side.
Excellent. Well, thank you, everybody, for attending. I appreciate it. Have a great rest of the day. Dan, Robert, Stephen, thank you so much. We appreciate it.